All right, in today's video, we're going to be talking about options trading for beginners. I'm going to break it down to simple terms about what it's all about. Now, options trading in itself is really not a complex thought or a concept. It's, you have a directional opinion about a stock and you say, okay, I just want to buy some options. I'm going to buy a call option or I'm going to buy a put option. Most people think it's that easy. Now, if it was that easy, everyone would be making money. But options trading, think of it like, if you know how to drive a car and you need to get to the store, but if you don't know where you're going, if you don't know where to turn, if you don't have your iPhone telling you turn left here or turn right here, you're just going to be driving around aimlessly, not getting anywhere. It's the same thing with options trading. Yes, you know how options may work and you know there's a stock market and you have an opinion about a stock, but if you don't know how to navigate the options trading world, then you're just going to be fumbling around buying calls and puts that aren't making you any money, and you're just going to give up in disgust and you're going to lose your money. So in today's video, I'm going to sort of give you a roadmap, so to speak, of how options trading works, because the concept is simple, but once you get into it, it's a little bit more complex than that. So let's just jump right in and start talking about options trading for beginners and how to do it properly. All right, so before we start really getting into some examples, I want to talk to you and show you my cheat sheet here for, a couple of things that you should know about before you start trading options, all right? And then we'll get into the meat of it. Now, for the beginners here, let's just kind of go over some of the guidelines of what options trading is all about. Number one, if you want to trade options, you have to have a brokerage account. You can't just, say I'm going to trade options and just figure out how to do it. In order to trade options here in the US, at least, you have to have a brokerage account with a broker. Now, you may already have a stock account where you can buy and sell stocks, but you also have to have options trading permission. So if you don't have options trading permission in your brokerage account, then you apply for options trading permission. You have to fill out a form and you have to tell the broker, what your thoughts are, what kind of trading you want to do. And in this case, we're going to be talking about very simple buying options. Okay, that's pretty much the most basic options trading strategy you can do is buying options. So number one, you got to get yourself a brokerage account. If you don't even have a brokerage account yet, then you have to open up an account. Now, down in the description below, I have a link for one of the brokers that I use, and also on our website, I'll show you later on our FAQ page, I have a list of other brokers that could be possible for you to look at. Okay, so now that you have that you have to have a brokerage account. There's only two types of options. There's call options and put options. And in this example, we're going to talk more about call options because that's more of a bullish strategy. Buy call options, it's bullish. We'll touch on put options just a little bit. And there's only two types of players in the options market. There's buyers and sellers, okay? You either buy an option or you sell an option. We're going to look mostly from the buying side today. And in order to trade options, you have to have some kind of directional opinion on the stock that you're going to trade those options on, right? Now, options aren't just something that you trade on their own. They have they're a derivative product. The value of these options are derived from something else, and that's the underlying security, which in most cases is a stock. So if you have an opinion on a stock, whether you're bullish or bearish, then you can trade the option contract. So number one, you have to have an opinion on the stock, then you can trade either a call or a put option, all right? The other thing is that options have a price. Just like a stock has a price, options have their own price as well. And that option price is called the premium. So if you buy or sell an option, you're either paying the premium, or if you're the seller, you're receiving the premium. Okay, so an option has its own price. And options also are the equivalent to 100 shares of stock. Options trade in contracts. So one single option contract is the equivalent of 100 shares of the stock that you're trading those options on. So you need to understand that. Okay. So if you're planning on playing with, 500 shares of stock, then you can play with 5 option contracts, all right? So, these are just some of the basics that you need to know ahead of time. And all options have different strike prices and different expiration dates. And this is one of the things that really trips up new option players, is that they don't know which strike price to choose and they don't know which expiration date to choose. Now, there are options that expire every single day of the week. There are options that expire every Friday. of the month. And then there's options that expire the third Friday of the month. So you have ones that expire every day, some that expire every Friday, and then ones that expire once a month, the third Friday of the month. So you have to figure out which expiration date do I want to choose, and the strike price, of course. Now, over here, options trading can be as conservative or as aggressive as you like. You can really go all out and take the lotto type of trades, where these are like the 1 in a million type of trades that will only cost a little amount of money. Most people tend to gravitate towards those type of lotto plays where they only spend a little bit of money, but if it pays off, it can pay off big. The downside to that is that the probability of those types of trades paying off are so small, so minuscule, that most people just end up throwing their money away because these things are never going to pay off. Now, you can play conservatively, which means you're going to spend more money, but you're going to get more bang for your buck, meaning if you pick the right strike price and the stock moves properly, the option value will move in your favor. So you have to figure out, how much money am I willing to spend versus how much probability am I going to get of being profitable on a trade? So there's these things that you have to factor in, okay? The other thing about options is that they can be bought and sold at any time. You can buy them 1 minute, sell them the next minute. You can buy them now, you can sell them a month later, buy it now, sell them 6 months later. It all depends on which expiration date you choose and whether the stock moves quickly in your favor or not. So you don't have to hold an option all the way to its expiration date. A lot of people don't understand that, okay? Getting down to the bottom here. And options offer great leverage. As I said, with options, you can control a large amount of stock with just a small down payment or a small payment up front. When you buy an option, you have to pay for that option in full up front. You have to pay the premium, but now you're controlling all that stock for the fraction of the cost. So that's another draw that brings people into the options market, is that it only takes a little bit of money to get involved into a trade. So, and that's a good thing as long as you know how to use that leverage. And then these down at the bottom here are two things that really trip people up on how they understand how options work. Number one, you should always understand what your break-even price is. Okay, when you buy an options contract, the stock has to move to a certain level in order for that option contract to pay off for you. So it's very important to understand how much the stock has to move to get to at least your break-even level. Okay, and that's assuming that you're going to hold the option all the way to expiration. And I'm going to pull up an option calculator. I'm going to show you how to do what-if scenarios. And the last thing is that you should really understand how delta and theta work. Delta and theta, if you've never heard of them, these are what are called, some of the Greeks, they're called the Greeks. These are outputs of the option pricing model, and the delta and theta will give you some really good information about the options that you choose to trade. All right, so let's just jump right in here and start looking at an example of what and how we can use options, as you're beginning your journey into the options trading world. So let's pull up a chart here of Apple. Okay, this is a daily chart of Apple, scanning back about 2 years in time till about, let's say, where are we looking here? This goes all the way back to about August of 2022. All right, so it's maybe about two and a half years of time, a little over 2 years in time, all the way back here. And you can see Apple's gone from a low of about $125 to its current price of $222. Okay, so right here, $222.78. That is where Apple closed recently on January 24th, 2025. Now, one of the things that you need to understand is that when you decide on a stock that you want to trade options on, you have to know where the stock is trading, where it's been, and where you think it's going to go. Now, for those of you that are into fundamental data, which is the sales growth, the earnings revenue, expenses, price to earnings ratios, all those fundamental data items are great to know. But unless you look at a chart and see where the stock's been and how it's been trending, you really shouldn't be trading options off of fundamental data. This is part of your roadmap, is that you have to look at a stock chart to see where the stock is currently, where it's come from, where it's been, and where you think it's going, and in what time frame you think it's going to get there. One of the hardest things about options trading is that not only do you have to have an idea of where the stock is going to go, up or down, but how soon it's going to get there. And that's the time frame part of it. Most people have a lot of trouble getting the stock direction correct in the time frame that they choose as the option expiration date. It's very hard to do. So you have to have some kind of opinion. Now, looking at a stock chart can tell you how a stock's been trending. Now, yes, we can see over the last 2 years or so, Apple's been trending upwards, but it's had some periods of sideways movement as well. And you want to understand how much or how far does a stock like Apple go in 1 month timeframes or 1 week timeframes or 1 day timeframes, depending on which options you're going to choose. Okay. So if you're going to choose a 6-month option on Apple, it's good to look back on a rolling 6-month basis and see how far the stock has been able to move in a 6-month period. Okay, if Apple only has been moving, $10 higher or lower over 6 months, then why would you think it can rally $100 in the next 6 months? It would be really hard for a stock to do that. Okay, so those are some of the things you need to think about. So let's just take an idea here. So let's concentrate on buying call options on Apple. We're going to look at some option chains here, and we're going to look at some numbers, and we're going to talk about buying a call option on Apple. And the reason why you're going to buy a call option on Apple is because you're bullish on Apple. You think Apple's going to go up in the future, so you want to buy a call option. How do you choose that? And this is all how option trading for beginners is. You pick a direction and then you choose an option based on that prediction. Okay, so let's pull up our option chain here. Okay, so this is an option chain for Apple. We got call options on the right, put options on the left. Here's the bid and ask prices. These are the columns that you want to concentrate on most. The bid and ask column, you have your delta column and your theta column. And I'm going to show you exactly what those numbers mean. And here are all the expiration dates for Apple. Apple has expirations that go every Friday of the month. And if we click on the more drop down here, you can see all the expirations for Apple. Now, what this means regular is that is the regular third Friday of the month expiration. And as you get closer in time, you can see the ones that don't have regular next to it, these are the weekly right now, the weekly options. And as of March 21st, right now, they only have the monthly. And as we get closer in time, then a lot of these February and March options will become weekly options. Okay, that's just how Apple options work at the moment. So let's take a look here. So let's just assume, okay, you're bullish on Apple. You think it's going to go higher in the future. How do you choose a call option? All right. So for now, we're going to choose the next regular monthly expiration for Apple, which is February 21st, 2025. It's got 26 days left until expiration. And we're going to use what's called we're going to look at the at the money options. At the money options and here's the strike price right here. The strike price of these are the options that you can trade. You can't just randomly come up with a price and say, I want to trade this option contract. The strike prices are set by the exchanges, so you have to choose one of these. You have to choose one of these strikes that are already created. Now, the at the money strike is what's considered the strike price here, which closely resembles the current price of the stock. So Apple went out, and this is in the after hours market up until 8 p.m. Eastern time, $2.22.17. It closed regular hours at 4 p.m. Eastern. I think it was like $2.22 and maybe 80 something cents. So the 222.5 strike, that's $222.05. That's what's called the at the money strike. It's the closest one that resembles the current price of the stock. Now, since we're looking at call options, we scan over to the bid ask column and we see on Friday, January 24th, 2025, each option contract, just like a stock, will have a bid and an ask price. And if you're going to buy these options, you're going to buy at a maximum $7.65 per contract or something in between. We always try to shoot for a value in between. So let's just say you can buy this option for $7.60 per contract, $7.60 per contract. Now, in order to figure out the actual true dollar value is that you have to multiply these numbers by 100 because each option contract consists of 100 shares of stock. It's what's called the $100 multiplier. You multiply these numbers by 7, by 100. So if you're going to buy a contract for $7.60, the actual cost is $760. Okay, so now you know you're bullish on Apple. You're going to buy an at-the-money call, which is the 222.5 strike calls for $7.60 a contract. That will cost you $760, and it expires in 26 days. Now, for you as an option buyer right now, the most important thing for you to figure out, what is the break-even price? Where does Apple need to move up to in order for me to at least break even on my trade? Very easy to figure out, easy math. You take 222.5 and you add $7.60 to that. So 222 plus $7.60 is $230.10, right? Let me double check my calculator. I want to make sure that's right. 222.5 plus 7.6 is $230.10. So at a minimum, if you hold this option all the way to expiration, which is 26 days from now, Apple has to move all the way up to $230.10 just for you to break even. All right. Now, versus if you bought 100 shares of Apple stock at $222.17, that would cost you $22,217. Okay. So it's over $22,000 you're going to pay to control 100 shares of Apple. Versus if you buy the call option, it only costs you $760. So you're getting over a $21,000 roughly discount for buying the call options versus buying 100 shares of stock. You always have to compare everything to what 100 shares of stock would cost you. So $22,000 for the stock or $760 for the call option. You're thinking this is a great deal. But remember, if you hold the option to expiration, Apple has to get up to $230 just to break even. Above that, then you're making money. So now you have to figure out, well, what are the chances of Apple moving up to $230 in the next 26 days? Okay, this is where the part of the probability comes into play. Versus if you just bought Apple at $222 and it went up to $230, you would make $8 per share. You'd make $800. But if Apple finishes at expiration at $230, you're not going to make any money if you bought the call option. $8 a share, you as the call option buyer will make absolutely no money. And that's a hard thing for people to understand. They say to me, well, I bought a call option, the stock went up, but I made no money. How does that happen? This is how it happens. You have to figure out what your break-even price is and know where the stock needs to get to in order to at least break even or make money. That's if you hold it to expiration. So let's pull up let's go to our option calculator here, and I'll take you to our website in a minute. Let's go to our calculator here, and I'm going to show you some what-if scenarios. Now, you can go to barchart.com. I'll put a link down in the description for this free options calculator. Now, options calculator is a great tool to help you do what-if scenarios. So if you're going to buy this call option, you want to know how much that option is worth at varying levels of the stock movement and varying days to expiration, okay? So what I've done here is I've already inputted this into here. Let's bring this down to 26 days to have it match up with. So let's go back to the chain here. So the 222.5 calls were worth about $7.60 on Friday. So let's go back here and figure out let's make sure everything matches up here. And so Apple closed at $222.78 on Friday. January 24th. Here's the strike price. Let's put in the days of 27. We'll go back a day or so, and we'll see how the theoretical value. So these are your inputs here. You can change all these, and the output over here. So we're looking at the call option, and here's your drop down for the calls or puts. You can choose your expiration date here, and you can choose your strike price here. You can change all these things. So you can see the option value is worth $757. Let's see if we move this up to 28 days. What happens? We can probably go back to Friday. Let's keep it at 20. Let's keep it at 28, and we'll bring down the volatility a little bit so all the numbers will match up. Okay, so here, roughly $7.59. Okay, that's around the same price that you would have paid. Now, let's bump up the option. Let's bump up Apple stock price to $230, and we'll take down the days to expiration down to 0 days. So this is on expiration day. Okay. Now, on expiration day, even though Apple jumped up from 222 up to 230, the 222.5 call is only worth $7.50. You paid $7.60 for it. So you haven't made any money at all, even though Apple stock went up. That's at the end of expiration. Now, let's look what happens if we had it at 28 days. Let's see what happens if Apple rallies up to 230 with 26 days left. So Apple jumped very quickly from the time that you bought it. Now you can see the call value is worth $11.75. So if you bought it for $7.60, now you can sell it for $11.75. That's because Apple rallied very quickly in the first 2 days after you bought it. So speed is the key here. You have to figure out how quickly can Apple move from point A to point B. Now, once again, let's take this down to 1 day to expiration, and you can see the value has gone back down to $7.54. So if Apple jumps up really good in the first 2 days and you don't take your profits and you decide to wait because you think Apple's just going to keep going up, and in reality, it just peters out at 230 and you only have 1 day left, now you can sell it for, almost what you bought it for. So taking profits along the way is a really important thing to understand as well. You can sell this thing, soon after you bought it. If the stock moves in your favor quickly, take the money and run, because as you can see, if the stock peters out, it's not going to make your option value go up. Let's go back to the chart here, and you can see for Apple, look at all this sideways action. If that happened with your option that you bought and the stock didn't go up to where you needed it to, you're not going to make any money. Okay, so probability is big. The other thing that we can look at is our probability calculator. Okay, so this is something that we have on our website under our services tab, our probability calculator. You can get this thing. We put in some numbers here. Let's put in 28 days left to expiration. Future volatility is around 30%, and we want to know if Apple going up to 230 from its current level. Okay, so here's what we do. We're starting at 222. Let's put this at 0.7, 222.70. And the next 28 days, what are the chances of Apple going up to $230? And we click on go. So here's your opportunity here to see. This is the box you want to concentrate on. There's a 34.89% chance that Apple will go from 222.70 all the way up to 230, which is roughly your break-even point. Actually, if we wanted to know the exact break-even point, it's 230.10. Click on go again. So now we're 34.7% probability that option will pay off for you if you hold it to expiration. Okay. Now, if Apple only jumps up to if Apple, your target is 230.1. and we have 1 day left. Okay, now there's hardly any chance with 1 day left, Apple can go up about $7.5, $8 a share. Speed is key here. Okay, probability tells you, the less time that you have, the less opportunity, or the less probability you have to make money. Okay, so let's go back to the option chain here and look at another example. Let's say, let's look at the 250 strike, which will only cost roughly $84. $84 to control 100 shares of stock versus $22,000 to control 100 shares of stock. But in this case, Apple has to, if you're looking at the 250 calls, Apple has to rally above $250 just for you to break even though it'll cost you only $84 to buy that. This is what I call more of the lotto trade. It only costs $84, but Apple has to go from 222 all the way up to 250 in 26 days. That's very hard to do. Let's go back to the calculator here. So 227 in 27 days up to 250, you're going to see the probability is going to be very small. Okay, click on go. Okay, so there's only a 7.8% chance for Apple getting up to $250 in the next 27 days from where it started from. Now, that's up to you. If you want that kind of trade, that's what I call more the lotto trade, very small probability. But if Apple gets up that far, especially very quickly, you can make a lot of money. If we go back to the option calculator, so if Apple's at 222.70 and you have 27 days and you bought the 250 calls, so we changed the strike price, okay? That's worth, 64 cents. So it's a little bit lower. Let's bring the volatility up a little. Okay, let's take it down to about 31%. All right, so here, about 83 cents. Now, if Apple jumps up to, let's say, 240 in the next 2 days, we'll drop this down by 2 days. Now look at that. You can sell the option that you bought for 85 cents. Now you can sell it for over $4. That's incredible. But if it takes Apple almost all the days to get up there, now it's only worth 9 cents. You see, with 2 days left, even though Apple jumped up to 240. So once again, the timing is very important. How quickly do you think the stock is going to make that move from point A to point B? Now, do you want to take a real lotto trade where you'll have a very small probability of that, but it'll cost you less? Or do you want more of the at the money trade where it costs you more, but the probability of the stock getting to where you need it to go to is higher? It's all about a balancing act. These are the things that most beginning option players don't understand, is that they don't know what probabilities, they don't know how to choose a strike price, they don't understand the break-even levels. You have to know where you need the stock to get to in order to at least break even. And if the stock makes the move quickly, don't be afraid to take profits. You can get out early, sell it, take the money and run. Now, one of the last things I wanted to talk about was, we go back to our cheat sheet here, is the understand delta and theta. Okay, let's go back to the option chain. Now, delta in this column tells you how much the option value should change in conjunction with a change in the stock price. Now, if we look at the 222.5s, the at the money strikes typically have what's called a 50 delta. Deltas range from 0 to 100. The higher the delta, the more correlation it has with the stock movement. So at the money options typically have close to a 50 delta. The calls have a 53.9 delta, and the puts have a 46.5 delta, okay? In this specific case, with Apple being where it is. What that means is that if you bought the call option and the deltas, this is 54%. Okay, 0.39, about 54%. So if Apple jumps $1 per share, this option contract should move up in value by about 54 cents per contract, or $54. So it's about half of what the Apple stock does. If Apple goes up $1, the call option should go up about 54 cents per contract, or 54 actual dollars. Okay. Now, if you look at something more like an in the money contract where the strike prices are situated well below the current price of the stock, like the 200 strike call is well below the current price of the stock, has a roughly 90 delta, which means when Apple goes up, that option value is going to go up about 90%, or 90 cents per contract, $90. But this one costs about $2,430. So do you want to spend $2,430 but get all the same movement and have a break-even price of roughly $224? Take the strike price, add the value, and that would give you $224.30 as your break-even. That's only about $2 higher than where Apple currently is. So you'll have a higher probability of making money, but it's also going to cost you more. So once again, you have to weigh out what you want. Now, we can go out to different expiration dates. Let's go out to May here, for example. And the 220 or the 225s are what's considered the at the money, because they don't have that in between strike. So let's just say you bought the 225 calls. Now those things are worth about, you're going to pay $12.50 for those, $1,250, because you're giving yourself more time. The longer out in expiration you go, the more that you're going to pay for the option, but it also gives you more time for the stock to move in your favor. So once again, you have to figure out how much time are you willing to give. Now, what the way to figure that out, if you're still confused about which expiration date to choose, look back at the chart and see how far has the stock been able to move in the time frame that I'm considering. So if you're looking at a 1 month option for Apple, look back on the chart and see how far has Apple moved in 1 month time frame. Each one of these sections is 1 month. You can look down here at the bottom. This is going by month. So you can see Apple really doesn't move much more than $10 in each month. Okay, here's another month right here. It's about $10. If you look over here, each little square is 1 month time frame and about $10 in price change. So this box right here is about a $10 move from 180 to 190. So if you're going on a 1 month time frame for your expiration date, you know Apple has a history of really moving about $10 per share. So if you think if you're playing on Apple moving 30 to 40 or $50 in 1 month's time frame, you're going to have a very small probability of that trade working out for you. Yes, it may cost you not that much money, but your probability to win is going to be really small. Now, if you bump yourself out to a 3 month time frame, then you look back, where has Apple been able to move in a 3 month time frame? So 1, 2, 3. So this rectangle is about a 3 month time frame. So that's about a $20 move. Okay, so Apple can go about $20 in a typical 3 month range. So now if you're playing a 3 month option, realize Apple's history is that it can move about $20. So that's how you can also use your probability there and figure out which strike price and which expiration date you should use. Now, lastly, I wanted to talk about Theta. Theta here in the column. Theta, okay, so Theta tells you on a dollar basis how much the option contract is going to change overnight. Now, option prices don't stay stable, don't stay the same the moment that you buy them. Option values change every single day. And one of the things that makes an option value change is what's called time decay. Meaning as the stock moves toward, as the option moves towards its expiration date, it's going to shed a little bit of its value every day. And that's what's called time decay. As we turn the calendar to the next day, the option is going to be worth less the next day, all else being equal. And that's called time decay. And so here, the Theta column tells you how much that option value is going to be worth the next day if everything else is the same. So the 225 calls for May is going to lose 6.7 cents per contract. That's $6.70 per actual dollars, just because you flip the calendar to the next day. So if you bought these things for $12.50, tomorrow it's going to be worth $12.44 or $12.43 just because of time decay. You have to understand that. Now, the closer you get to expiration, let's look at these February 21s, the 225 calls has a theta of 14 cents. That means if you bought it today at $6.35, tomorrow it's going to be worth $6.21. So as an option buyer, that's one thing that you're fighting is what's called time decay. Just because you bought the option and you flip the calendar the next day, you're losing money regardless of what happens. So you have to take that into consideration. At the money strikes have the highest theta decay or time decay. So you're fighting a losing battle. Each day that the stock doesn't move in your favor, that time decay is killing you, is taking money out of your pocket because the option's moving on towards expiration. And like I said, if you go out to a further expiration date, the theta is smaller. But yet the option will cost you more. So once again, it's a trade-off. Do you want to spend more by going further out in time and get less theta, daily theta, or do you want to take a shorter term expiration where the option will cost less, but the theta is greater? All these things you got to factor in when you're trading options. It's not as easy as you think. Most people come into this thinking, I'm just going to buy some calls and I'm going to make all this money. Well, a lot of it's fighting against you. So you got to understand how delta works, theta works, which strike price to choose, and which expiration date to choose. And if you can get all that done, then you're going to make yourself some money. But also, big factor is you have to look at the charts and you have to figure out where the stock is been and where it may go in the future. And you have to use technical analysis to figure out. Now, in this case of Apple, Apple's had a nice little dip here. We know Apple is going to go up in the long run in the future. So, you can potentially use this. Here's the 200-day moving average on my charts. This could be a really good support point for Apple to launch its next move higher. So you have to use technical analysis, chart reading to understand potentially, where the stock could go and how far it can go in a certain amount of time. All right. So I hope this has given you some good information on options trading for beginners. These are some of the things you got to figure out. Let's go back. I'll pull up the cheat sheet here just in case you want to take a look at this again. Now, for those of you that are saying, wow, buying options can be really hard. For us here at the Smart Option Seller, we take the other side. We're the actual sellers in this case. We're not buying options, we're selling options. And as an option seller, it's a much easier way to make money because you don't have those constraints of having to figure out where the stock's going to go and what time frame. We're just trying to figure out where the stock isn't going to go, and that's a much easier thing to do. So if you've never really thought about option selling, go to our website. Let me bring up our website here. smartoptionseller.com. We're all about selling options, mostly put options. If you want to understand what selling put options is all about, go to our website, click on our free ebook here, Put Selling Basics. It talks all about selling put options, why it's such a high probability winning strategy. Scroll down, put your name and email address in here, and we'll send you an email back with a link for the free ebook. Okay. If you want a little bit deeper dive, you can look into our video series about selling put options. You'll get 30 free days to our newsletter as well. And in our services tab right here, we have 2 newsletters. These are paid. These are all paid things right here. Our 2 newsletters about selling put options, selling put option credit spreads. We have our coaching. If you want to get a leg up, if you need help, if you're just starting out, you can look at our coaching sessions and our probability calculator, which we have for sale. You just saw how we use that. Now, the other thing I want to show you is I just updated a recent copy of my Warren Buffett book, Ride the Coattails of Warren Buffett. It's using a different option trading strategy than what I talked about today, or it's somewhat connected to what I talked about today. So have a look at this as well. All right, so I hope this has been helpful to you. I make these free videos for the trading community. Down in the description, I've got links and books and websites that could be helpful for you. Also, the broker that I use is listed down there. Give me a thumbs up, give me a like. Let's make these videos go viral. I just recently hit 1 million views on all my videos combined. I'm really happy about that, but I want to get 1 million views on a single video. So hopefully that'll happen one day. I'm here to help you all for free. Give me a thumbs up, give me a like, send me an email as well. On the screen here, I'm going to put two other videos, one about put selling and the other about how to make money, become a millionaire in the background passively. All right. That's all for me today. I will see everyone in the next one. This is Lee Lowell signing off.